Would the Walt Disney Company actually spin off ESPN, one of its most lucrative branches of the company? That question came earlier this week from hedge fund manager Dan Loeb, who just recently reacquired a new large stake for his investment company in Walt Disney. And he's asking that question. He put a letter to the board and to CEO Bob Chapek, urging them to consider a spinoff, something similar to what we just saw with AT&T regarding Warner Brothers and Discovery and David Zaslav. But does this actually fit inside the Disney model? Let's talk about some of the numbers and why he thinks this makes sense and why I think this makes no sense. Let's get into it. Renegade Online. Well, welcome back. Another great day here at Valliant Renegade. It's good to see everybody out there once again. And if you are watching this video, not yet subscribed to this channel, please take a moment, consider hitting that subscribe button, hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, do leave a comment below the video before you head out the door today. Glad you folks are here and welcome aboard to the channel once again. Let's talk about some of this news. This kind of was a bit fascinating, came out of I want to say left field, but not really left field because this same investor, this same institutional investor, Dan Loeb, has tried to do this before. And let's show you what I'm talking about here. It was October of last year when there was initial discussion of Disney considering, or at least on the table, discussing, however you want to call it, spinning off one of its most valuable components of its company, one of the components that has one of the best positive cash flows the company can count on from quarter to quarter and fiscal year to fiscal year. And of course, that's ESPN. As we've talked about here on Valliant Renegade many times, nothing beats the advertising power and the cash generating monster that is live sport broadcast through its linear delivery. And by linear delivery, I mean traditional linear content delivery through cable, through broadcast television like ABC, cable like ESPN, all the different ESPN channels it has, versus its DTC or direct-to-consumer component, as many studios and Hollywood companies now have, where you have a streaming service with a subscription. Now, in this article from the New York Post last year in October, we see here that the initial report came from a story published by Puck News, a source that we've frequently referenced here at Valliant Renegade. That is a great source of inside baseball Hollywood information, let's call it. And of course, it says the initial story published by Puck News said Disney CEO Bob Chapek had tapped some of his closest deputies to explore a separation of the sports channels from the rest of the company. One unnamed source is reported as having told the publication that, quote, there are now conversations happening regularly at Disney about whether or not to spin off ESPN. But an anonymous person close to the company told CNBC that the story wasn't accurate. Now, for the record, I have complete faith in what the folks over at Puck report in terms of the information they're getting from the inside on not just Disney, but all of these major companies. They have some tremendous connections, especially Matthew Maloney, who is the former editor of The Hollywood Reporter. He certainly is talking to people that are in the know, at least as far as this guy is concerned here at Valliant Renegade. But be that as it may, I think that the denial was maybe a tacit admission of the fact that this conversation probably was going on. And quite frankly, I have no expectation of why it wouldn't go on. In companies like this, the size of Disney, with as many branches as they have into as many different facets of entertainment media, they certainly would have these kind of conversations from time to time. Is it viable to still keep this asset inside Disney? Should we spin this off? And of course, ESPN is kind of a cash machine. And I think that's one of the things that keeps ESPN at Disney, and we'll get to that in just a moment to show you some of the actual numbers of why I think this resurgence of this idea that Disney should spin off ESPN is a bad one. So while I think the conversations have occurred at Disney and do occur at Disney from time to time, not just with ESPN, but with probably a great many of their properties, that doesn't mean that it necessarily is a forward motion project, meaning that this was something that might have come up during a brainstorm session and might have been revisited a few times to look at what are the pros and cons, but that doesn't mean it was ever under any kind of serious consideration that that type of move would be going forward. But this is where we come full circle now to almost a year later with investor Dan Loeb. Let's talk about that one. So all of this started when Dan Loeb's Third Point investment firm had taken a new stake in Disney, the stock itself, and the shares jumped on the news. And Loeb's stake is worth roughly $1 billion, as Reuters reported on Monday, and that would, of course, come following an SEC filing from Third Point Investments regarding this major stake. But from the letter, quote, ESPN would have greater flexibility to pursue business initiatives that may be more difficult as a part of Disney, such as sports betting, Loeb said. Quote, we believe that most arrangements between the two companies can be replicated contractually in the way eBay spun out PayPal while continuing to utilize the PayPal product to process payments. Disney is making more money from cable subscribers than any other company, solely because of ESPN. ESPN and sister network ESPN2 charge nearly $10 per month combined, while Disney requires pay TV providers to include ESPN as part of the most popular cable packages. And that's something key to remember, because as of right now, I realize a lot of people watching this video are wondering, well, Valliant, how is that still relevant these days with all of the quote-unquote cord cutting that is going on? The cord cutting really doesn't play into this factor because live sports are still so sacrosanct that they still reside largely on broadcast and linear television. And the reason for that is because the revenues needed from this type of content can only come from advertising-based systems, which is still predominantly linear delivery television through your basic cable provider like Cox or Charter or Warner or Comcast or whatever they're calling themselves these days, or all the other myriad of different cable providers throughout the country. Satellite TV, same thing, whether you have Dish Network or DirecTV. These are still linear content providers. If you have an antenna on your house still picking up ABC, NBC, CBS, Fox, so on and so forth, over the air, broadcast, same thing. That type of advertising revenue cannot be replicated, at least as of this point, inside of most, if not all, the streaming services that are out there, but particularly Disney or Disney Plus or any type of Disney-based streaming service apart from maybe Hulu, because they're just simply not there yet. Now, they are coming later this year, and we might see the winds start to shift, especially when it comes to ESPN Plus. But that's for another day, because we're not quite there yet. But let's go back to this, because I think it's important to understand a few other key factors. ESPN Plus, a streaming service with limited content, has become a stronger product in the past year as Disney moves to more exclusive live games to the service. Disney said last month that it will raise the price of ESPN Plus to $9.99 a month from $6.99 per month starting August 23rd, the largest price increase to date. Now, the reason why that's happening on August 23rd is not by accident. It's starting this coming Monday because this is when we're starting to launch into college football season. And in case you didn't know, a lot of ESPN Plus's content revolves around smaller college divisions that don't make it to the big linear broadcast networks, that simply don't have the space because they cannot command the kind of advertising power that a Big Ten or an SEC conference can command on ESPN, the regular linear delivery channels. And there's certainly been a big market for it, including myself. So this is why we're seeing ESPN Plus climb the ladder to the tune of about 30 to 35% at this point, just in the next week. Dan Loeb's letter goes on to talk about an early buyout of Comcast from its 33% stake in Hulu, which would cost Disney probably somewhere at this point at least around $10 billion or so, depending on where the final figure works out. But that's for another video. What we want to focus on here is this deal to actually spin off ESPN simply in order to take advantage of things like sports betting? Think of DraftKings and things like that. To take advantage of sports betting, online sports betting, that Disney itself does not want to be directly involved in, at least per se at this point. That may change down the road. But is it worth it to Disney to do that? Is it worth it to spin them off into something like a Warner Media with, merged with Discovery to where they still have controlling interest in the company? The problem is the revenues would be off the balance sheets. And those revenues are crucial to Disney, especially right now as they're still building their own streaming service, particularly Disney Plus. You see, Hulu is fairly well matured and is a profit generator. ESPN Plus is more to the break-even point, if not already generating profit for the streamer. Disney Plus is where the most pain on the balance sheet is for Disney from quarter to quarter. It's where the most pain is in negative operating income because of the high cost of producing content like, She-Hulk coming out right now, and all the other Marvel series, or a couple $100 million you spend making a show like Obi-Wan Kenobi that gets a decent response up front and then quickly falls off the minute it's over. Live sports tend to be far more sustainable and certainly can carry a much higher command for positive revenue generation, and they can't get that anywhere else. Let's look at Disney's balance sheet. Here's Disney's third fiscal quarter report that just came out back on August 10th. We covered it here during a live stream on Valliant Renegade, and I want everybody to really understand what's going on here because this is what makes this important. For people who want to understand where Disney gets their money from, this is how it happens. Segment revenues for the quarter ended and the 9 months ended. So let's take a look at these one at a time. Disney Media and Entertainment Distribution. Now that is a conglomerate of theater, linear, and direct-to-consumer content that Disney puts out. And linear television is by far and away the biggest money driver. $14 billion in the quarter ended July 2nd, 2022. For the 9 months ended, $42 billion in total revenue. Disney Parks, Experiences, and Products, $7.3 billion. In other words, when it comes to total revenue for the Walt Disney Company, their actual media delivery, theatrical, linear, and DTC, drives in almost twice as much total gross revenues to the Walt Disney Company as all of their theme parks, hotels, and merchandising combined. But now let's look at the next segment, and this is where things change up a little bit. Segment operating income or losses. In other words, how much money, how much operating income did Disney actually generate after they paid back all of their expenses for making that money? What was the actual net business income from those two divisions? Disney Media, Entertainment, and Distribution, $1.38 billion. Disney Parks, Experiences, and Products, $2.18 billion. In other words, the reverse is true once we factor out the expenses of both of these different divisions. So while their media, entertainment, and distribution makes almost twice as much in a quarter as do the parks, they only pull in about half the amount of net business income as the parks do. And that's due to the fact that, we've all had this conversation before on YouTube, the actual profit margin on those park tickets, on those hotels, on those merchandises, and those products that you buy with the Disney branded logo on it, much higher than the profit margin that comes in from television and theater. But even still, that Disney Media and Entertainment Distribution, that $1.38 billion, what does that really break down to? Let's take a look. Revenue and operating results for Disney Media and Entertainment Distribution segment are as follows in millions once again. So when we see linear networks, 7,000, it looks like a 7,189. It's really not. That's actually 7,189 million because these figures are in millions. You can see direct to consumer. That's Disney Plus, Hulu, ESPN Plus right below it at $5 billion. Content sales and licensing and other, another $2 billion. But when we look down there below at operating income or losses once again, look at the difference. Linear networks at 2.46, almost $2.47 billion for linear networks. Direct to consumer, they lost almost $1.1 billion. And if you'll watch us talk about this on the live stream, this is where we talked about how Disney Plus and that DTC family lost another $1+ billion last quarter. So what do linear networks really comprise? What is the lion's share of that $2.47 almost billion profit they had for linear networks? Without question, the biggest contributor to that $2.4+ billion profit in linear networks is live sports broadcasts. And that number is going to get bigger as we move in to the NFL season, which is coming up. What incentive would Disney have at this point to actually spin ESPN and all of that cash machine off the books? What incentive would they have to cough up all of that positive operating revenue, especially during a time when Disney is still suffering losses on the direct-to-consumer model? $1 billion again this quarter, almost $2 billion on the entire year. And that's the issue. That's the problem, is that we're looking at this point in terms of DTC is still struggling to get to profitability, and Disney does not project that to happen until fiscal year 2024, or at least by the end of fiscal year 2024, which is 2 years away from September 30th of this year, 2022. So they have a long way to go. Now, might Disney spin off ESPN at some point down the road? That's always possible. But I think there is a 0.0% chance of that happening anytime before DTC becomes lucrative enough to reach a healthy degree of profitability. And we are still many, many years away from having DTC haul in $2.5 billion a quarter in positive profits for the Walt Disney Company. And that will never happen if they actually cough up ESPN and the associated sports contracts that go with it, even to an entity that they would still hold controlling interest in. It wouldn't still be on the Walt Disney Company's books. So I think the idea in theory and principle to say that, well, let's do this, or I think this is a good idea because it will open up doors for us to get into the basically gambling. It's sports betting is what this guy is talking about. I don't think that that is in and of itself going to be able to replace, at least not for a very long time, that is probably not going to be able to replace the kind of revenues they're getting now from advertising on their massively multi-billion-dollar, huge value sports contracts. You just can't do it. That's where the money for Disney is made, is on those sports broadcasting contracts and on the parks and resorts. So that's it. Let me know what you think in the comments below. Make sure you hit that like and subscribe. Share this sucker out on the social medias, and until next time, take care.